afternoon and welcome to another edition of Unlock the Stock. Today we are featuring the Spear REIT and the Adcorp Group. You know by now that Unlock the Stock is specifically formulated for retail investors to get to know corporate management and their businesses just a little bit better. Unlock the Stock is only possible with our technology partner Lumi Global. Their website is lumiglobal.com and you can visit it to learn more about their online AGM and investor presentation solutions. Our host, as usual, will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they'll be facilitating the Q&A session in the respective breakout rooms once you get there. We would really like to welcome back Christian Barnard, the CFO, and PFAFF-KARG, the CIO of Spear REIT, and a new company joining us today, Adcorp. They are represented by Dr. John Wenzel, the CEO, and Noel Prendergast, the CFO. Before we start, there are just a few housekeeping rules. Each company will do a presentation which will take about 12 minutes. You will then see a button at the bottom of the screen which guides you to the breakout room. If you can't find that button immediately, you need to use the menu under More, and you will find it there. The Q&A sessions will be about 20 minutes before we regroup in this plenary session again. You're more than welcome to leave one room and join the other. Questions are posted by typing them into the Q&A box at the bottom of your screen. The event is being recorded, as it usually is, and will be available on the Unlock the Stock YouTube channel next week. Once in the breakout room, you will see an email address. If you want to be on the company's contact database, please jot that email address down. So Kim and Christian, I'm ready for you. So when you are ready, could you share your screen and take us through your presentation, please?
Okay, good morning, everyone. Thank you for making the time for listening to us again. We're excited to tell a bit more about Spear in the past and what's exciting things that's going on in the near future. There's a bit of the context of today, but also this presentation will be on our website, so please go download as there's a lot of information in here which we can't touch on in the 12 minutes, but it's free for you guys to download and go read and make an informed investment decision. Just a bit of history about Spear. So Spear obtains its specialization through regional investment and its diversification through its asset type investment, and it purely invests in the Western Cape. Spear was founded by Mike Flax, Abu Varacha, and Quentin Rossi, our CEO, which is in a well-deserved break in Spain. So we wish him well and come back soon. And today, myself, the CFO, and PFAFF-KARG, our CEO, will take you through the presentation. Spear was listed in the JSE in 2016 with an asset value of 1.4 billion. Today, we control 4.62 billion of assets with a GLA of 426,000 under management. And Spear is internally managed, and we have an ambition to try and grow to a 15 billion assets under management and with a market cap of around 9 billion rand. This is just a synopsis of our timeline of what Spear has achieved since its inception and listing to date, where we have on February 24 with a couple of key acquisitions that along the way, our listing and where we are today at 4.62 billion in assets. Now, just to remind everyone of the Spear's mission is to be the leading Western Cape focused REIT and to consistently grow a distribution per share ahead of inflation and to operate within the top quartile of our peer group. We are value investors and we want to remain authentic, consistent and sustainable dividend paying real estate investment trust. We own a high quality industrial convenience retail and strategically place commercial assets within the Western Cape. We prudently recycle capital through disposals. Spear's strategy is to provide a sustainable and growing distributable income as a listed REIT through yield accretive acquisitions and the execution of our smart strategy. Spear has consistently delivered on its market guidance since listing in 2016, and we're proud that we've never missed the guidance we put out to the market. We would like to operate on a strong balance sheet and with an LTV ratio of between 38 and 43% at any given time. At the current stage, we're operating well below that, and Kim will tell you why as we are gearing up for some exciting acquisitions in the future.
Thanks. Good afternoon, everybody. I'm going to be taking you through the Spear investment strategy. So first and foremost, Spear is a 100% Western Cape-based fund, which means that we exclusively invest in the Western Cape, and we intend to keep it that way. We are a diversified fund. However, from a sectoral point of view, we strive to consistently have an industrial and a retail bias, both in terms of gross lettable area and value whilst remaining value investors. We aim to have a minimum asset size of 100 million rand unless an acquisition is particularly strategic. Our emphasis remains on quality over quantity. We will only grow the fund with assets that meet our strict investment criteria. Across the portfolio, we have around 150,000 square meters of unutilized bulk, which we plan to unlock over the next 5 to 10 year horizon, as and when market conditions are conducive. This represents considerable upside in the Sphere portfolio, as we do not value any of this bulk. And finally, we intend to grow our fund, which, as Christian mentioned, is currently around 4.6 billion, to a meaningful mid-cap sized fund in the region of 15 billion rand, which is more of a strategic growth intent than a specific target value. In terms of our portfolio snapshot, as at our year end, we had 29 assets, portfolio value 4.62, year-on-year increase 9.78% in our portfolio size. However, on a like-for-like basis, this was 3.5%. The differential is that we purchased the island, which is a high-quality logistics centre in Tobin Island, for 185 million rand. Our average property value is 157.6 million rand, and our average rate per square metre across the 3 sectors is just over 10,000 rand a square metre, which represents very good value for a high-quality portfolio, all located within the Western Cape. Our in-force escalations, so that's the escalation rate across all sectors, is 7.52%. Our gross lettable area is just over 426,000 square metres. Our average occupancy, 93%. Our weighted average lease expiry term, 26 months. And our average rental, including rates, so that's a gross rental, is 108 rand a square metre per month.
In FY24, for the year ending February 2024, we collected 98.90% of our cash collections, which has improved to over 99% post-balance sheet. We generated 36 million at net cash from operating activities, which is after paying all our dividends, all expenditure, all operating expenses we acquire. We need to have free cash flow to actually improve our portfolio without delving further into debt. Looking at the financial snapshot, in the past financial year, we generated distributable income per share of 82.99 cents per share, which was a 1.04% growth on the prior financial year, which we are very proud of given the high cost environment we're currently operating in. After applying a 95% payout ratio, we paid dividends of 78.86 cents per share, which was a 3.8% growth on the prior financial year. Our SA REIT cost to income ratio is at 43.69%, and our SA REIT admin cost to income ratio is at 6%. Our tangible net asset value per share is 11.79, which grew from 11.47, which was a 2.79% increase, and that is largely driven by our core portfolio's fair value adjustments, showing underlying growth of over 9% in the top line revenue. At year end, our LTV was 31.6%, which is below our strategic band, as we're gearing up for a very exciting acquisition later this financial year. We have fixed debt ratios of 47% at year end, which is currently at about 70% post-balance sheet, post some disposals, and our average weighted debt expires at 25 months, and average cost of debt is at 9.48%. This slide just shows you the total return if you had invested in Sphere in March of 23 up until February 2024, being a 23.1% total return if you reinvested your dividends, beating the JSE REIT index and the small cap index. And this will even further improve after year end if you look at what the market has done after the stable elections we had and a positive news from the GUNA coming out. Then our sectoral performance for FY24 across our 3 main sectors being retail, commercial and industrial. Retail is a 47,000 square meter GLA under management, of which 41% is led to national tenants. We had an occupancy of 95%, rental collections of 98%, and rental reversion, positive rental of 11.03%, and in-force escalation of 7.47%. Our commercial portfolio is 126,000 square meters, with an occupancy of 84%, collections of 97%, in-force escalates of 7.43% and negative rental growth of 4.67%. Now, we are very proud in the past financial year, we fully let number 1 Waterhouse, the Bloemhof Tiger Valley asset, as well as Liberty Life. And as you have seen on SENS, we recently announced the disposal and let up of 100 Fairways, a building which is a commercial asset, which takes our occupancy in commercial to well over 90% in the asset currently stands. Industrial is our star performer, and we have a positive 6% rental reversion, occupancy of 97%, collections of 99%, and we have a robust in-force escalate over 7.7%. Kim mentioned the acquisition of the island in the past financial year, growing our industrial portfolio, which was acquired at a 9.7% yield, but is yielding over 10% post-acquisition. And we've also started the bulk infrastructure work for services in George and our industrial development, which we accepted to complete the bulk infrastructure in October of 2024, when we will start then with our top structure development.
Briefly looking at our sectoral split by value, revenue, and GLA, of the 4.6 billion rand portfolio, 48% is offices, 35% industrial, 16% retail, and 1% developments. Property revenue, we collected 607 million rand in the last financial year, and the split very much mirrors the value of the properties. Of our gross lettable area, the lion's share is industrial at almost 60% of the total GLA, 30% offices, and 11% retail. Of the 29 assets, 14 are offices, 9 industrial, and 6 retail. Property occupancy of the 93%, offices are currently at 84%, which has improved since year end, and 97% for industrial and 96% for retail.
This slide gives you a snapshot of Spear's solar portfolio, which we started our journey installing solar on a portfolio in 2018 in one of our retail assets. And to date, 55% of our portfolio is covered with solar, generating over 7.7 thousand kilowatt hours of green electricity. We are proud that in the next financial year, this would increase to just under 10,000 as we continue to expand our solar portfolio and making sure that all solar installations provides a high IRR in the high teens. And we are comfortable that there's a further rollout strategy within the Spear, and this is a fantastic financial incentive for the company, as well as making sure we follow our ESG approach for people, planet, and profit.
Post-balance sheet activity, so after our financial year end, which was Feb 2024, 2 properties transferred out of our portfolio. The first one is 142 Edward Street, which is a non-core office asset in Tiger Valley that we sold for 43 million rand in March. The Liberty Life building in Century City, we sold to Capitec for 400 million rand. We transferred out of the Spear portfolio in May. Subsequently, as announced on SENS, we've entered into an agreement of sale to sell 100 Fairways Parow to the City of Cape Town. This transaction is still subject to Competition Commission. In terms of acquisitions, we are very excited about our portfolio acquisition of 13 fund quality properties, which we acquired from the Emira Property Fund. The total value being 1.146 billion at an initial yield of around 10%, and we expect these properties to transfer in December this year. Post-implementation of the Emira transaction, the value of our portfolio will have increased to 5.4 billion, and our total gross lettable area will be just over 500,000 square meters.
Looking at the outlook for FY25, the macroeconomic climate remains extremely challenging despite the stronger performance of the Western Cape. The Western Cape fundamentals and the governance in the Western Cape has led for strong demand in rental post-balance sheet, as well as further investment from various funds as well as private investors into the Western Cape. Now, we've seen this in our portfolio where there's a strong demand for rental space, but that doesn't take away from the fact that the higher for longer interest rate environment will in the short term dampen profitability. We are of the opinion, and some financial institutions are the similar opinion, that interest rate tapering cycle are upon us, and it might start as early as Q3, but possibly only in Q4 of FY25. We're excited for the new acquisition, as Kim just mentioned, because this will just bolster our core portfolio with yield accretive acquisitions, which meaning a better return for shareholders going forward. Now, why do you get when you invest in Spear? You get exposure to diversified, Western Cape only real estate portfolio. A conservative valuable core portfolio with no value attributed to developer bulk, which is future unlock for shareholders. And management team and board display strong shareholder alignment with circa 24% investment in the company. The core portfolio is defensive, underpinned by strong lease covenants and high quality tenants. Consistent dividend paying REIT since inception that has never missed its guidance provided to the market. Simplistic capital structure, no exposed to cross-currency interest rate swaps, and an easy to understand income statement and balance sheet. Excellent capital allocation track record since the listing on JSE in 2016, committed to the measurable ESG strategies, and we operate with a strong balance sheet of only 24% loan to value ratio. And that is what I have to say today, and I hope you enjoyed the presentation. Thank you.
Thank you so much, Christian and Kim. John and Noel, we are ready for you to take over and take us through your presentation, please.
Good afternoon, everyone. Welcome to this presentation of the Adcorp Group. My name is John Wenzel, and I'm joined by our CFO, Noel Pendergast. In terms of an overview, this is the first time that we are appearing here, so it may be useful just for people who have joined, just to understand a little bit about the Adcorp Group. So the Adcorp Group is a workforce solutions company. It's part of the staffing sector. The group is 49 years old. It was founded in 1975. We've been listed on the Johannesburg Stock Exchange for 35 years. Being in the staffing sector, the group has a large number of employees, and at the end of our last financial year, we had 41,772 employees and contractors on our books, and we remain the largest listed staffing company on the African continent, and also one of the 100 largest listed staffing companies in the world. And we have a large number of brands, which we'll show you in a moment, but those brands have achieved multiple awards across sectors of trustworthiness and customer excellence. If you look at the Adcorp structure, the Adcorp Holdings Ltd structure, that's the entity that's listed on the Johannesburg Stock Exchange. It has three entities underneath it. We have Adcorp Group South Africa that holds all of our South African operations. We then have Adcorp Holdings Australia, which holds our Australian operations, and Adcorp Africa Limited, which holds our international operations. The group focuses in three broad areas in terms of the services that it provides, and it provides those services through a large number of brands. Our contingent staffing focus is very much the provision of contingent labor in the typical blue-collar sector, and this would be employees mostly into industrial-type operations, both here and in Australia. And that covers things like logistics, agriculture, retail, and so forth. The second area that we focus on is what we call professional services. And this is really focused on the white-collar segment of the market. And that covers permanent placements, contingent placement, contractors, and freelancers. Most of our clients in that sector are in your typical services industries, financial services, telecommunications, and so forth. The third area that we focus on is called staffing solutions. We changed the name at the end of last year. If you look at our IR, you will see it's referred to as functional outsourcing. And that particular focus area delivers fully outsourced services, where we take over the non-core labor value chain components of our clients. And that is across a whole range of sectors, very much an overlap in a sense with contingent staffing. On the right-hand side, you can see the range of brands that we operate under. There are 18 brands that we operate under. In the contingent space, we have brands like Blue, Zest, Labour Solutions Australia. Some of you may be familiar with some of these names. I won't go through all of them, but they cover everything from blue-collar contingent, which is blue, all the way through to specialized services such as Charisma, which is a nursing business, LSA Health, which is a healthcare business in Australia, and ICANN, which is a disability solutions business in South Africa. The Adcorp business model, underpinned by 5 things. One is a broad and diverse range of service offerings. Our service offerings cover everything from contingent workers and gig workers through to contractors, permanent employees, and contingent workers. Geographical diversification, we operate in 2 major markets in South Africa and Australia. You will notice in the previous slide, we talk about our Africa operations. That is headquartered at Mauritius, and that is an area that is growing, so it doesn't make a significant contribution at this stage. The Adcorp operating model is very much client-centric and brand-focused. And what you will see is that you may recognize the Adcorp brand, you won't necessarily recognize the Adcorp name. We don't, in a sense, sell Adcorp as the brand, but many of the underlying brands. And that really enhances our customer focus. Our customers buy our brands, that's why they come to Adcorp. And our brands have been around for a long time. We also have a very specific sector focus. We focus on specific sectors where we believe we have a competitive advantage, and we have excellent strength, for example, in technology with brands like Paracon in South Africa and Paxis in Australia. Very strong brands in our industrial and outsourcing space. So we don't cover all sectors, we cover very specific sectors where we believe we have a competitive advantage and where the market requires our services. And then we have significant flexibility in the ability to provide workforces to our clients that cover everything from permanent to contingent to temp to contractors, and the ability for us as an organization to provide flexible workforces to our clients. So as the client demand changes, they may want permanent today, they want contingent tomorrow, and contractor the day thereafter. We can provide that flexibility to our clients because of our scale, which is in excess of 41,000 employees. We recently released our FY24 results, and if you look at our FY24 performance, I think there's a lot that we as an organization are proud of. Our revenue has climbed by 7.7%, and last year we reported revenue of 13 billion ZAR. Our cash generated from operations, 248 million, but that was before the deployment of 124 million into working capital, and that very much underpinned the organic growth that has delivered the top line revenue growth. Total headlines earnings per share, 83.8 cents, up 37.2% over prior year. Prior year we did have one-offs that negatively affected the performance. The gross profit has been the one area that we've seen significant pressure in the previous financial year, and that was down about 2% at 1.26 billion. And again, very much a reflection of the macroeconomic forces at play in South Africa and to a significantly lesser degree in Australia. But notwithstanding that, we delivered a net cash position of 204 million, and that is excluding the restricted cash. We have got restricted cash in Angola of circa 70 million. So if you include that, we probably up at about 275 million in net cash. Total earnings per share up 124% over the prior year at 83.8 cents. Again, as I mentioned earlier, the prior year's number was suppressed by a once-off charge associated with the discontinued operation. Total profit after tax, 88 million, up 115%, 116% over prior year. And then we declared a dividend of 24.2 cents. That was the final year dividend. If you look at the interim dividend that we declared was 16.1 cents. It takes total dividend for the year to about 40 cents. And then finally, if you look at our balance sheet, our gross debt on a pre-IFRS 16 basis is zero. So we've got no debt on the balance sheet. And that's a continuation from last year when we also reported that we had no gross debt on the balance sheet. So I think overall we've delivered what I would call a resilient performance in FY24, very much against the backdrop. I think as Spear also indicated, it's been a tough and a difficult year in South Africa. I think all of us on the call know the South African economy and the challenges that it faces and what it faced last year. And we saw a recovery in economy in Australia. So I think overall a resilient performance in FY24. If you look at the breakdown sector-wise in terms of the earnings profile of the business, which I think is certainly an advantage for our shareholders or our investors, 53% of our revenue currently comes from South Africa and 47% of the revenue comes from Australia. As I mentioned earlier, Adcorp Africa is in the startup phase, and our Australia revenue continues to grow faster than our South African revenue. So for investors, if you're looking for a rand hedge stock, this is probably not a bad stock to consider, as just under half our revenue comes from Australia. When you look at EBITDA, 49% of the EBITDA comes from South Africa and 51% comes from Australia. We also see superior EBITDA margins in Australia. They're slightly better than South Africa. And if you look at the focus split, the bulk of our revenue comes from our professional services divisions, both here and in Australia, about 47%, our contingent staffing about 44%, and then our staffing solutions at about 9%. If we look at the outlook for FY25, there's 6 things that we think colors that outlook. One is we are anticipating the recovery in the market. Hopefully South Africa, with the new government and business-friendly policies coming to the fore, and in Australia where we see inflation and interest rates falling, and that should drive demand. We have delivered, I think, excellent cost control in FY24, and we'll continue that in FY25. Over the last couple of years, we've been able to keep cost growth below inflation, and that's been a strong suit of the company. We will be investing further in contingent staffing, and as well as our staffing solutions business, our outsourcing business, both here and in Australia. We see good growth in the contingent staffing market. We will further be pursuing ongoing geographic diversification, very much around Africa, where we see the opportunity to grow in places like Mozambique, where there's been significant investment or potential investment in Cabo Delgado in the oil and gas sector. And then in FY24, we expanded into high margin sectors, and we will be expanding that and continuing that in FY25. And those sectors that we expanded into in FY24, they cover business process outsourcing, which in South Africa is showing good growth. Hospitality in South Africa, we've seen the recovery in the tourism market, particularly in the Western Cape, and that's been good for us. And then in Australia, where we see expansion in the healthcare sector, there's a structural shortage of aged care workers in Australia that we think is good for us. And then we will be looking to make acquisitions to further accelerate our strategy. Our balance sheet is completely ungeared, so we've got the capacity to make acquisitions without straining the balance sheet, and we certainly are actively on the lookout for acquisitions both here and in Australia to accelerate the growth that we've seen. If you look at the Adcorp investment case, then in summary for investors looking at the staffing sector or looking at the services sector, the positioning of Adcorp, we have a strong market position, the largest listed staffing company on the African continent, and a significant play in Australia, and that gives our investors a good rand hedge with half the earnings coming in relative hard currency. The financial position is strong. We remain debt free, and that's something that we've managed very well. Our working capital management has also been very strong, notwithstanding the significant pressure we see, especially in South Africa, with terms on clients going out to 60 days, 90 days. We have been able to manage DSOs at 37 days. That remains really hard to maintain, but we've done that now for the last 2 or 3 years. And then revenue growth. We've reported revenue growth going to 13 billion. That's the third consecutive year that we've delivered sustainable top line growth. And then ultimately, it's about the returns that we've delivered to our shareholders. If you look at the last 3 years, we've delivered over 220 million rand to our shareholders through ordinary dividends, special dividends, and share buybacks. That excludes the final dividend declaration that we made. If you include that, and that dividend will be paid in August, then we will have delivered by the end of August 248 million in returns to our shareholders. So hopefully that's given you a bit of a view as to what Adcorp's about, and we look forward to taking any questions when we go into the breakaway rooms. Thank you.
Thank you so much, John. That was a great overview. So as a reminder, you can select the breakout room. If it doesn't appear at the bottom of your screen, it'll be in the drop-down menu under More. So I'm going to let everyone go to the breakout rooms where you'll be joined by either the Finance Ghost or Mark Tobin. I'll see you back here a bit later.
Christian, Kim, can you hear me? I just want to make sure you can. Perfect. Okay, we will get straight into it. There's still a few more people, I think, joining or coming across and deciding which room, but let's get into it. I just want to maybe kick off on the portfolio. So I don't know maybe if this is one for Kim rather than Christian. A lot happening, a lot forecast to happen, but maybe just touch on, I guess, how hard in the Western Cape, given it's, you know, the best performing province, is it to find deals, recycle capital, you know, get out of one thing that you think where you've, you know, added the value over the last couple of years and find an asset that, you know, fits what you're looking for, but, you know, where you can add value and try and exit on the other end, you know, 5 to 7 years down the line.
Thanks, Mark. It really has been quite difficult the last couple of years, but it isn't impossible. Looking at a case in point is our recent transaction with Europe, where we've managed to secure 13 high quality assets, all in the Western Cape. In fact, they're all in Cape Town. So, you know, what makes it a little bit more tough really is the interest rates. The interest rates are making deals difficult to close because of owners' expectations in terms of pricing. And as you quite rightly mentioned, the Western Cape is the prime province in South Africa, and there's so much capital chasing few quality assets. But we really do keep our ear to the ground. We've got strong relationships with other landlords, REITs, brokers in the industry. So we're constantly doing our homework in terms of what is available for sale and how we can possibly transact on those assets.
And if I maybe could add, I think what we've shown in the past years being listed is that we don't just grow for the sake of growing. We have no manco that earns fees on the asset base growing. We internally manage and want to grow distributions to our shareholders. So we will only do accretive acquisitions, and if that is one a year or a portfolio acquisition like we're doing now, then so be it. But we're not running just to go buy for any sake. We want to make sure it's the right deal for our shareholders.
And then maybe a follow on to that question. You know, you've got the new project breaking ground in George. You know, is that something that we should expect to see more of from Spear as we move forward on a 3 to 5 year basis? You know, we've got Winelands Airport coming out by me here in Stellenbosch. You know, George is absolutely booming. Every time I talk to anybody from George, you know, there's just so many people moving down there. I think they're building a whole new Mediclinic in George now as well. And you know, those kind of more regional assets in towns like wherever, George, Hermanus, the Winelands more broadly, you know, Parle, Stellenbosch, because it is quite a Cape Town centric at the minute. And obviously that's, you know, where a lot of the properties are. But, you know, is that something you're looking at to maybe be a few more regional properties into the mix?
100%. We are not afraid to take a drive to any well-governed town within the Western Cape. And when we say we invest within the Western Cape, we truly explore all options within the Western Cape. And George is an example where we obviously will be building our industrial park now, which we've already commenced with the civil infrastructure. We are continuously looking at assets throughout the Western Cape. And just like Cape Town, nothing is cheap in the greater Western Cape, because the great part of the Western Cape is well managed, good infrastructure, access is quick to Cape Town. So people are still expecting high yields, even in the outlying towns, but we are constantly exploring. So we're here. We're looking for Western Cape in total, not just Cape Town.
And would that be, you know, more in the industrial space, you know, kind of further out, you know, given there isn't, you know, the malls that you kind of get in Cape Town in terms of size, you know, there one mall even in a reasonably sized town wouldn't kind of make your kind of 100 million thing, but you know, an entire industrial park or something like that. So would it be more on the industrial side, do you think, in the regional areas rather than the retails?
We will also look at retail and industrial, and as Kim mentioned, 100 million is a strategy to acquire assets of a higher value and lesser management requirement. But if it's specifically strategic focus, let's say at 50 million, we will look at it. We'll give it its due diligence and look at it. So we won't just wave it away, because you're right. You might not buy a 100 million rand asset in Vredenburg. Okay, they have the Weskus Mall, which is probably 700-800 million rand, but there is other assets in the area which is well located and fantastic. So we will definitely look at it. But yeah, so it is industrial and retail at the moment. And offices, we're buying a couple of offices together with the Meta portfolio, but they're all well located in close proximity to our current assets. So we know the nodes, they're high, the occupancy rates are high, so we know how to manage them and how to treat them. So but at the moment, we're focusing on industrial and retail assets, and we would look at mixed use assets in the right nodes.
Yeah, perfect. Just a reminder to everyone, if you do have questions for the Spear team, just pop them in the chat and we'll tackle them as they come. Just a question maybe for you, Christian, in terms of, you know, where we are in the interest rate cycle, you know, where the book is in terms of rolling off from, you know, those very low rates we saw in COVID to where we are now. How much of the book is, I'm just thinking of, you know, finance costs as we look at, you know, the next half and the half after that. You know, we've seen with a lot of companies right across the board, but maybe particularly pronounced in the REIT sector, you know, big jumps in finance costs as those low interest rates that we saw on COVID roll off. You know, where is Spear in that kind of continuum of, you know, how much has to roll off into the new environment?
Yeah, I think we're quite fortuitous. We work quite hard to make sure our book is the hedges we have in place and the swaps actually all only come up in the 26th financial year. So we believe within the tapering cycle. So we are continuously talking to the banks to what we call a blend and extend. So what they will do is if the future swap curves are showing significant downward pressure, we would enter into new swaps and they would blend the old rate with the new rate to give you a more average rate. We haven't done that in the past 6 months because the last swap we did was in February of November of 23, where the rates for a brief period gave a dip. There was like a short period, a window where people started seeing how the new normal will look after CPI comes down worldwide. But that's out the window again, and we're back to the old expensive rates. So we don't have any pressure on this financial year. It's only in FY26 we will have the hard work lie ahead of us. But then I think we will firmly be into the tapering cycle for that 1% forecast in the next 12 to 18 months.
Okay, and maybe just staying on interest rates, given this is such a key part of asset recycling, as Kim said, and and a line on the P&L for REITs more broadly. You guys are particularly lowly geared. I think if you look at REITs across the sector, you're just above 30. A lot of them are kind of heading more towards 40, and the odd one over 40. As we enter the tapering cycle, are you looking at pushing that back up again, trying to get back up closer to 40, or given, as you said, it looked like everybody was predicting 3 interest rate cuts in 24. Now we'll be looking to see any, I think. Are you still thinking, no, let's keep it on the low end until we actually see movements from central banks? I know we've had a few go already, but the 2 main ones I think for South Africa is our own one and what the US is doing, given it drives such volatility in the rand.
Yeah, so our low interest rate or LTV currently is very strategic, given that Kim found this significant portfolio for us to acquire. So once we knew we had this portfolio, we started on a disposal journey to actually get our gearing lower, so to allow us to be able to gear back up into a strategic band of 38 to 43%. And we're very comfortable to operate in that band because the age-old saying in finance is debt is still cheaper than equity, especially in the current market. Our share price is still severely below our NAV, so we won't just go issue equity for any cost, but we can use our strong balance sheet and our core portfolio to increase our gearing to a band of between 30 and 43% to acquire. And Kim found these 13 assets, and post this, we will be about plus minus 39 to 40% in terms of gearing. So we will be back up there, but that's prior to any other adjustments in the portfolio, any other fair value adjustments or disposals. So it's a strategic low LTV currently. Hence, also there's a lower risk in terms of any interest rates that if there's any shocks in the market, because we are at 24% currently, we are kind of protected in that sense. But the new acquisition will come into play, let's say about December, which we will be in the middle of the start of the tapering cycle. So then we will continuously fall in, and we will work to get that LTV back into the mid-30s quite quickly again.
I've got 2 questions for Kim here, I think. Kim, first one, office vacancies, problem right across the sector. Everybody, I think, who has even a passing interest in REITs will know any of the REITs that have offices, either as part of a mix or, are majorly focused on them. It's been a very, very tough time, even post-COVID. A question around why have office vacancies been so volatile for you guys? I think people are looking at half on half, and it seems to be gyrating all over the place. So maybe just give a comment on that. Is it 1 or 2 big tenants, kind of leaving and downsizing, or is it, something you're trying to manage from a mix within office that, you're kind of happy to let these ones kind of go, or maybe just comment on that office volatility mix?
Sure. So as you say, offices have had a really rough couple of years. And even before COVID, but after COVID, it was really essentially driven by the work from home. The Western Cape in general has been more protected due to the fact that especially Cape Town has become an absolute favorite with BPOs, which is call centers. So call centers have taken up large floor plates of offices, of well-located offices in Cape Town. Now within the Spear portfolio, we fortuitously have all of our offices are well located. So they've been more or less protected. But in terms of our vacancy rates specifically, of our 3 sectors, it is the sector that has the, should I say, the lowest occupancy, but it is something that we are continually working on. large floor plates, there is demand. It's the smaller pockets that sometimes are a little bit more sticky. And then after this, the sale of 100 Fairways, we'll also see the vacancy decrease significantly or meaningfully.
Yeah, if I may add, at year end, the office occupancy was actually a recorded number, which is a bit of there was a strategic vacancy included in there within this asset we just announced to dispose last week, Friday. We knew that the buyer wanted to let the entire space. So we were kind of stuck that we couldn't let it out to someone else, but they were going through their processes and to sign it. We finally were able to announce it last week, and now 8,000 square meters of office vacancy has disappeared for us, and they immediately occupy the building. So they are going to buy it, but effectively they're paying us rental from the day the signature of the agreement. So now our office vacancy or occupancy is back over 90%. So at year end, there was a very strategic pocket that there was a bugbear for us, but we also couldn't tell the market that what we are busy with because it was price sensitive. So now that we've announced it, we can say that the building is back to fully let. We're back over 90%, and we've done even better deals than other parts of our portfolio. So offices are moving. Demand in the Western Cape for smaller pockets and office has come back. It used to be, as Kim said, BPOs taking big chunks of space. But now the smaller 100 to 500 square meter tenants are back, and they are letting space, and we're seeing it across the board. Our leasing guys are running up and down doing deals as we speak.
Yeah. And then the second part. Sorry, Kim, go ahead.
Sorry, Mark, I just wanted to add that Cape Town, or the Western Cape, is also seeing some real nice growth in office rentals, and that is an offspring from the BPOs, the additional demand to the Western Cape.
And then the second question is related to the Emira transaction. Obviously, a great transaction because you're getting, is it 6 properties in total in that group coming across? But the question is kind of, you're going to get all 6. Are you happy to keep all 6? Or are you, a bit like the deal that you announced last Friday, you had to wear the not being able to lease in order to get the deal done later on? Is it, take all 6, but we actually really want 4 and the other 2 maybe not core, and we'll, try and put them into the asset turnover, asset rollover program over the next 12 or 18 months?
So there's actually 13 properties all in all.
Okay.
And as you say, sometimes, with the portfolio, you can't pick and choose, but generally we're very happy with the quality of all the assets. A couple of the properties are below our threshold of 100 million. So it's not that we would necessarily sell those immediately, but that's an example of assets that perhaps we would not have looked at on their own merits. But having said that, our first priority is to stabilize all the assets into our portfolio. And there are perhaps 1 or 2 that we would possibly look at on selling, potentially because they have additional development rights, or we could potentially look at JVing on those opportunities where we could unlock some further bulk.
Yeah, perfect. Then just another one from me, Christian, maybe one for you. As you said, you've got a share price trading below NAV. I just want to touch on the treasury shares that are on the balance sheet. Is there a plan to cancel them, or they've been retained to, for staff share options and bonuses through shares? And then just more broadly in terms of, doing share buybacks and dividends as part of the kind of overall capital allocation policy and, returns to shareholders.
Yes, at the moment, we will not cancel those treasury shares because there's unintended tax consequences in terms of CGT. Even though a REIT doesn't pay capital gains tax on asset disposal, you do pay it if you have to sell those shares because that's a part of your normal ordinary course of business. So we bought those shares from the beginning of COVID to now because the share price was trading at such a low, and we were buying them back at 11, sometimes at 13% yields, and we were generating free cash flow. So and as Kim mentioned, to go acquire an asset at 30% wasn't possible. People want 7 to 8 to 9% for their assets. So we utilize our free cash flow. We never utilize debt to buy these assets. And when the time is right and we find a suitable home for them in the market, when we can place them back into the market, we will place them back into the market, possibly for acquisition in the future. or we will utilize them for our staff share incentive scheme, because it's cheaper to utilize that than to buy back or issue fresh equity on higher yields. So at the moment, we won't cancel, but we do have strategic plans for them. But we bought them initially because it was at a high yield, because if you buy them back, they get taken out of the dividend pool, and your remaining shareholders actually earn a bigger dividend on the remaining shares. So we couldn't invest. You can easily buy 5 million of shares, but we're not necessarily going to go buy a 5 million asset for 13%. So that's the capital allocation we do, but we only do it with free cash flow and when there's a yield accretive line in the market to buy back.
And then I want to touch on, I know renewable solar is a big push within the REIT space, just given the roof space that you guys have, especially in maybe retail. In terms of, we have had no load shedding for the last like three and a bit months. What has that kind of feedback been through? I don't know if it's the leasing guys or, just catching up with tenants more broadly, Kim, in terms of, reduced diesel costs. Is it improving, collections, cash flow is better for tenants? They're seeing more footfall because people are also not spending money on personal diesel generators and stuff. Is it starting to reflect, or is it still, too early and people are kind of holding back because they think it's going to kick back in again in the future?
I think it's actually a couple of elements. Load shedding obviously is a big relief for everyone, because not everyone can have a solar system at their home to do it. But we can definitely see the fact that tenants are much happier, because we recover the diesel on a rand for rand basis that you spend to refill a generator, where it's a lot more expensive. If you have to recover from City of Cape Town, you more or less cover around R2.50 per kWh used, where a generator can be up to 10 rand kWh to run. So that's a very expensive exercise. And what also is then, in terms of taking you to the solars are a big financial incentive for REITs, especially on retail, as you mentioned. But when it's load shedding, your solar systems are grid tied, so then they are shut off. So then you lose the production from solar. So then you have to run generators, or you have to link a generator to the solar system, which is counterintuitive to why you have your solar in the first place. So when it's no load shedding, it's fantastic for tenants, because they obviously have cheap electricity to use. People have more money to spend, because they don't have to spend on all these generator costs. But then also we can provide cheaper electricity to tenants, as well as for ourselves, in terms of selling it onto our tenants, because it's not shut down with long hours of load shedding. So there's so many more positives than what we actually see in terms of when load shedding is not there. And not even to speak about the greater economy, how much better it is for GDP growth when tenants and factories can run 24/7, instead of having to plan these labor hours. Because what we have seen on our industrial side is these guys are very meticulous in how they plan their production shifts. So, and they know the load shedding hours. So then possibly if they have a big order to fulfill, they now need to actually pay overtime rates to run at night when there's no load shedding, where they could have done it during the day. So now it actually not only have to pay for load shedding and higher diesel costs, they have to have higher labor costs to make sure they can still meet their production demands. So there's other elements that load shedding impacts.
And then I just want to, I'm not sure if it's in the deck that is going up on the website now, but I know I just want to touch back on the George project. I know phase 1 was slated to be completed like April, May, and then you were going to move on to phase 2. Has that kind of timeline held true? I know we've had lots of rain down in the Southern Cape, flooding in PE, which is not a million miles away from George. And maybe just give us an update on that. I don't know if that's one for you, Kim or Christian. Is phase 1 completed and has phase 2?
Yes, so if you fly into George, you will immediately opposite the airport, you'll see a lot of activity. So firstly, we busy completing roadworks, traffic circles, bulk infrastructure is underway, which essentially means all the roads are going in, the services, the boundary walls, and in October, which does meet our planned time frame, we will be ready to commence with the first top structure. And of the development, we can develop 30,000 square meters of light industrial, typically related to airport uses, or food in the food industry. And we've had many inquiries to date. However, we're just in the process of consolidating some of the smaller users in order to commence with our first top structure. There are a couple of portions that we can start building on.
Then I've got a question here. I know you are 100% Western Cape focus, and you know that's a selling point. And I think you know, when you look at REITs more globally, you know, we're seeing less of the diversified guys and more of you know, everyone has their speciality, whatever that might be, whether it's geographic or asset based. But there is a question on, you know, would you ever consider, you know, doing Cape Town, Gauteng, or you know, Western Cape with a you know, mix of international, just to get a bit of like rand hedge, especially with, you know, a lot of your BPO clients in the office space. You know, a lot of them are based overseas, so you know, you already kind of know the tenants, even if they're based in Amsterdam or the UK. So maybe just, would you ever venture outside the Western Cape, or are you happy with what you've got in the current strategy?
No, we definitely like to travel for fun and not for work. So we will stay within the Western Cape, and the furthest offshore we will go is Robben Island.
Okay. As somebody who also travels to Australia quite regularly for work, yeah, traveling for work loses its charm very, very quickly. I think people who don't do it don't realize how charmless it is after you're on about your second or third trip.
Yeah. No, we are fully committed to the Western Cape, and there's still so much room for growth within the Western Cape. I mean, Kim has stats, but I mean, the likes of Growthpoint having 25 billion in assets, Redefine having 10 billion, and that's without any of the private portfolio owners. There's so much room for growth, and where Western Cape is continuously developed. The Cape Town, there's so many developments happening in terms of Growthpoint, new industrial logistics park, the new Investec offices, 91 redevelopment. There's a lot of room for growth. So we're optimistic. We have a lot of room to grow, and we will abide our time to get the right assets for our shareholders.
Yeah, I mean, maybe that's it was what going to be my last question. You know, given the geographic concentration and you know, just the size of the Western Cape market, like how confident you are of, you know, getting to that mid-cap REIT goal. But it sounds like there's still plenty of opportunities. It's just doing the Warren Buffett style, as you said, your value investors, and you know, waiting for the right asset at the right price, and not being you know, growing for the sake of growing.
No, exactly. We don't have hurry sickness. It has to, and I think it's very clear, because our board and management still owns 24% of this company. Every deal we do will be right for shareholders, because we're looking after ourselves and our shareholders. And I think that's a very key thing with our inside ownership. It's also a very good protection metric for any shareholder, and knowing that we will not do anything that's gonna impact the board's holding and ownership in the company and dilute them just for the sake of growing to earn an asset management fee.
Yeah. And then one final question, Kim. Any plans to extend out of the three main assets? You know, would you know, somewhere like, you know, George Airport or that, you know, or could potentially get into, you know, self-storage, or, you know, more mixed use where it's predominantly retail, but you know, maybe there's some residential on the top 2 or 3 floors of a, you know, of a big building. Is that something you're looking at, or just keeping it to the 3 core of office, industrial and commercial?
So we've always been very interested in data centers. It's certainly an area that we'd like to explore more, and it's a property class that we'd certainly like to own. And then, you know, we keep our eyes open, and we're open to opportunities in terms of other sectors. We do have a look every now and again, but we're pretty much focused on our retail and industrial, convenience retail in particular. And you know, we see a lot of value in the diversification of our fund.
Yeah. We don't have any further questions at this time, so I'm just going to say thank you to Christian and Kim for joining us today from Spear, and thanks again for coming back and joining us on Unlock the Stock, and send our best wishes to Quinton. Hopefully he'll be with us the next time, and not enjoying life in Barcelona. I'm going to hand back now to Vanessa. She should be joining us now in the main room just to wrap up and to give everybody an update on our next session, which is going to be happening next Thursday. So let me just close this room and then everybody will get pushed back into the main room.
I'll go.
I think let's start. People will pick where they go. So to those who have chosen this breakout room, thank you very much to come and learn about Adcorp. And John, Noel, thank you for making time for joining our platform. It's really great to just have you guys here for the first time. So thank you very much. I must disclose that I am a small shareholder in Adcorp. So it is a little part of my portfolio. So important to obviously just get that out of the way up front. And then obviously, as attendees are aware by now, you just send through your questions to me in the chat, and then I can direct it to the management team. So I think we'll kick off straight away, and we should have quite a good conversation here. And some of the questions will be quite fundamental, just because it's the first time you guys are on the platform. So thank you for that. So where I'd like to start is just an understanding of why it is that certain brands just are really good at specific sectors. I mean, that very much seems to be the Adcorp model. I mean, you talked to it in the presentation. This is not like a proudly Bidvest company kind of situation. The Adcorp branding is not all over your underlying brands. Why is it that brands are sector specialists in this game? I think it's great for people to just understand that as a starting point.
Yeah, it's a good question, and it's a combination of historical legacies. So Adcorp got to the size that it got to over the last couple of years. In fact, most of those acquisitions were made before this management team's tenure. And we bought brands like Kelly, we bought Quest, we bought Paracon. So firstly, a lot of those brands came through acquisition, and the goodwill came with the brand. So that's one of the reasons. The other reason that we see is that clients want specialization. So clients want to know that if you are providing, for example, healthcare, as we do through Charisma or through LSA Health, that you have a specialization, you understand the market, you understand the client needs, and you are dedicated to that. What we have seen, and that's why we moved away from this generic Adcorp brand, is that if you try to be all things to all people, you are important to no one. So we think it's a combination of legacy as well as clients wanting a dedicated focus, and it's worked for us. The final thing that it does allow us to do is when you have all of the services in one brand, and there are companies that do that. Randstad does that, Adecco does that, Manpower does that. There is a risk that you get cross-contamination if you have relative sector underperformance. So hopefully, Ghost, that gives you a bit of a sense as to why we've inherited this situation and why we continue with the situation. It keeps the brands very close to our clients rather than this big team at the head office.
Yes, and of course that decentralized culture, I guess, is a big part of the group, right? Because then you've got someone running each of those brands and they live and die by the financial performance inside that business, as opposed to many corporates that have somewhere for people to hide. Let's call a spade a spade.
Yeah, I think you're right. And that's the when Nola and I took over 3.5 years ago, we wanted to change the operating model to this decentralized. We think that the closer our employees are to the customer, the better decisions they are going to make, the faster they are going to make those decisions, and the more customer-centric those decisions are going to be. And as you say, ultimately what we want is to have an entrepreneurial culture where our management team look at the brand and they go, this is my business, we want to run it as a business. We want entrepreneurs in the business, we want people to run it as a business. So I agree with you. Having a big head office, which we had in the past, we've largely done away with it, does allow some element of hiding and does allow some element of cross-subsidization. Noel, I don't know if you want to add to that.
No, John, I think you've covered it well. Thanks.
So on the subject of the brands, I think I counted roughly 18 on that slide that you put up there. That sounds right? Yeah,
18 is the number that's active. We actually hold a total of 33 brands, but the remaining ones are dormant at this stage.
Okay, so it kind of feels like your runway for potential bolt-on acquisitions is vast, right? I mean, now I'll use Bidcorp as an example, the food service piece, which does bolt-on acquisitions all around the world. And they don't call everything Bidcorp. They just buy little food service specialists in countries all over the show, really. That is the one beauty of sticking to the brands that you buy, is the bolt-on acquisition story is a big part of what you can do into the future.
That's correct, Ghost, and that's certainly part of our strategy. The last few years, we've stabilized the organization. We've got on top of cash conversion. I think we've managed the balance sheet well, so we're well positioned to be able to make acquisitions without straining the balance sheet. And you're absolutely right. In a services businesses, generally you're not asset heavy. So your customer, when you buy something, you're actually buying goodwill. Also in a services business, it's not like a product where you go into a shop and there's a jar of peanut butter on the shelf and you can assess the jar and decide whether the label's skew or the product's moldy. Here in the services business, especially this kind of business, trust is what we sell, and brands embody trust, and that's why we're very, very sensitive about buying the brand and then closing the brand down, because most of the brand equity has been built up through customers trusting the brand. But yeah, absolutely, it gives us a lot of runway. We think there are a couple of sectors where we are underrepresented. There are a couple of sectors that we think we can potentially do both here and in Australia, a little bit of market consolidation, because it's also a scale game. Big staffing businesses need scale because it's, as you can see from our margins, they're low margin. It's not a high margin business, and therefore scale is important. So yeah, I agree with you. We see a lot of runway to do bolt-on acquisitions in both South Africa and in Australia.
John, if I could just add to that. Sorry, Ghost, if I could just
go ahead, Noel, go ahead.
You know, if you go back and look at the history of Adcorp, and I'm talking 10 years beyond, you know, there was a lot of acquisitions made. In many instances, probably overpaid for, which was clearly seen in goodwill write-offs over the years prior to John and I. But we're very cautious, extremely cautious, and that's why you haven't seen any active, sizable acquisition in the time period that we've been in management. But yeah, we're looking at everything, but we are examining everything in the finest detail of whether they add value, whether it's a bolt-on, whether it's a sector-focused, acquisition. And, hopefully in the next 6 to 12 months, we should be able to report some interesting ideas to bring to the group.
Now, caution in M&A is always a good thing. My post-articles career started in M&A, so I have much appreciation for understanding how dangerous it is, I guess, and there's a whole graveyard of companies on the JSE for people who ignore the risks of M&A. So, John, you raised the point of a market consolidator, and I'm glad you did, because that's something I wanted to ask you, which is, how much competition is there for good assets in this space? So how many Adcorps are there out there who will circle good assets and then fight over them, which obviously makes the M&A even riskier? Or is there not a lot of activity here, so you actually have a little bit of a buyer's market? It's just good to understand that relationship.
Yeah, it's a good question, and unfortunately, it's got a bit of a complex answer because we operate on two sides of the Indian Ocean, so we can't give you a single answer for both sides. So let's just talk about South Africa. Being listed in South Africa on the JSE, there are probably only 2 other listed companies who are primarily staffing providers. There aren't many listed companies in South Africa that play in this space. Most of the companies that play in this space tend to be a lot smaller. They tend to be privately held, and they tend not to be national companies. They are either regional companies or often city-based companies, and they often have quite a narrow focus. So when one looks at market consolidation, I think it is a combination of, it's a buyer's market right now, because it's easier, I think, to find assets that are for sale, because it's been tough in the sector for everyone over the last couple of years. So valuations on assets have fallen. But what you tend to find is when you're doing market consolidation and you are buying or potentially buying privately held, small, mid-sized businesses, the owners tend to grossly overvalue the business. And we've looked at a lot of assets over the last 2 years, and the valuation gap sometimes is just remarkable. So that's the challenge in South Africa. In Australia, it's a little bit different. There, the market dynamics are quite different. There are a number of listed companies in Australia, many of them much larger than the whole Adcorp group. And there we have to be far more circumspect, because we're not able to compete with the large companies with much deeper Australian-backed balance sheets. And there we're going to have to be very picky and very selective. So slightly different dynamics in both. But hopefully, Ghost, that's given you a bit of an overview. Noel, I don't know if you want to add anything to that.
John, I think I can just add a little bit. I mean, the Australian market is very buoyant in the M&A space, in the sector. The number of approaches we've had in the last 12, 18 months has been vast. Ghost, we see a lot less in South Africa. There isn't a lot of movement in this space, but there are certainly some acquisitions in the mid sort of tier. that could be very accretive for Adcorp in the future. But it has to be very focused, and I'll use that word caution again.
Yeah, especially on the offshore stuff, right? And especially in a services business, because you just don't have that big NAV to point to. So much of what you're buying is going to land on your balance sheet as an intangible.
That's right.
To your point, and you know, I've worked with enough private company owners in my life to know that they value their businesses based on what they need to retire comfortably. Like, that's not the valuation. That's what you want to get paid for it. These are not the same concepts. So that it is tricky when you're trying to mop up private companies to deal with some of those challenges and to avoid, as you say, those buoyant sellers markets. I mean, that can end really, really badly. So maybe last question on the acquisition side. Well, I can't promise last question. We'll see what comes through in my DMs, but certainly from my side for now would be, you know, what are your acquisition criteria then, other than caution and a lot of sensible stuff that you've already pointed out? But I'm talking controlling versus minority stakes, a preference for offshore versus local, for example. I'm sure you would love to do share-based transactions rather than cash, or maybe not. It depends on your view on your share price. So I'll open the floor to you now just to talk to how you think about your acquisition criteria when you're looking at these opportunities.
Yeah, so there are a couple of things that we look at, and at the end I'll ask Noel to, as the CFO, is probably even more skilled than I am at this. For us, an acquisition must be an accelerant to an existing strategy. Acquisition in and of itself can't be a strategy, and I think a lot of companies take acquisitions as the strategy. So for us, it must be an accelerant to an existing strategy. Secondly, we will acquire where we have core businesses that are already flying. You don't want to be acquiring and then bolting into a particular division or a brand when the brand is struggling, because then management attention gets defocused. Our growth areas right now are in blue-collar contingent staffing, both in Australia and South Africa. So that would be an area that we would be actively looking at. The other areas that we are looking at would be in those parts of our portfolio where the margins are higher and we've got a small market share, so that we've got lots of upside. We also don't want to acquire where we've got a significant play in a particular sector. So if we've got a market share of 25-30% in a specific sector, it doesn't make a lot of sense to go and acquire there, because your customer wants choice. And the risk is you take your market share to 40 and your customer then takes your market share down because they want flexibility. At the end of the day, we have the financial returns that we want. We want to make acquisitions that are accretive to ROIC, that exceed WACC, and that have solid margins, so that we get a margin lift. So there's a whole filter that we have for those acquisitions. But in South Africa, it'll be very much in the blue-collar contingent space, potentially in the outsourcing space. In Australia, it's likely to be in the blue-collar contingent. We don't have a preference onshore or offshore. Obviously, it's going to depend very much on the price we pay and the returns on that particular acquisition. And the final comment to make, and then I'll hand over to Noel. What we see in Australia is that we're getting far superior rates of growth in the Australia blue-collar contingent. That's because there is a structural shortage of blue-collar workers in Australia, circa 300,000 to 400,000, and we currently bring people in from the South Sea Islands into Australia on a 4-year visa just to deal with the shortage, and that would be, that area ticks a lot of boxes. Noel, if you just want to add anything you think maybe.
Yeah, I just wanted two things, as the Ghost said. A lot of the exits of these owner-managed businesses, it's not about them joining Adcorp. It is about them creating a retirement, and the value gap can just be too much. But I suppose one of the things that I look at very heavily when we look at these acquisitions is the cash. This can be a cash-hungry business if the working capital is not appropriately managed. So when we look at these acquisitions, we don't look at monthly cash or yearly cash. We look at daily cash, and we'd have to make sure that any investment we make is not in any way going to eat into the facilities that we have, and also obviously what the potential target has. So John, for me, that would be one of the largest criteria that we look at, besides all the other metrics that you mentioned already.
Yeah, it's a great point, because anyone who's been involved in watching a services business gently fall over will know that it can be capital light when it's working, and it can be very capital ugly when it's not, and your clients are not paying you, and you still need to pay staff, and you still have all your licensing and other exposures. I mean, services businesses can go bankrupt. That's a reality. Just because they don't have big factories and everything else does not mean they are immune from this, right?
100%.
Ghost, when John and I joined, we saw it very much in our face.
Yeah, absolutely. So let's maybe go to the other side of the coin now and disposals. Are you comfortable with the portfolio you have today? You know, without obviously giving away anything you can't give away, but just high level, you know, are you in more of an acquisitive mode right now than a dispose? That's the appropriate question.
Yeah, it's we are on both sides. So what we did last year, and in our IR we made mention of that. Isn't out here, we will make mention of it. We completed a portfolio optimization exercise where we looked at all of our assets under management, and that's the nice thing about, you know, decentralized brand-centric model, because it then allows the likes of Noel and I to manage the portfolio to optimize the returns of the underlying brands. We've got minimum returns criteria that we want the brands to operate at, and we give them time to get to that stage of delivery and that stage of returns. But if there's no viable way forward for a brand to achieve the minimum returns that we require, then we would look at disposal. There's also an issue of scale. As I said earlier, this is a scale business. So if you have brands that are suboptimal and lack the scale, then we would also look to dispose. So we are actively looking all the time at our portfolio of brands, because things change. You know, a brand that was great last year, maybe this year won't be so good, and next year may be terrible. So we are not wedded to holding all of the assets that we have. We will constantly look at that. If it makes sense to dispose of a particular brand, especially the small ones which may be non-core or not delivering the returns, we will look at that. But yeah, our focus is probably more on acquisition than disposal right now, Ghost.
Thank you. That's all super interesting. I'm really enjoying learning more about the business, should I say. So something else I wanted to ask you, with all these different brands running around, is there like a shared services model at Adcorp at the top, or do they all run their own finance teams, et cetera, et cetera? You know, to what extent do they plug into your plumbing, or do they kind of just sit apart entirely?
And I'll ask Noel to comment as well. So what we have done is we want these brands to run as far as possible as standalone. And therefore, as much as possible, we want them to absorb all of the costs that they need to run that brand. But of course, where it makes sense, we do have shared. So for example, your ERP system, it does not make sense for each brand to have its own ERP system. So there's a shared platform there. There are some critical aspects. I mentioned earlier, cash is king. And one of the things that we live and die by is exactly that, cash. So that is actually centralized. And that's to make sure that we never, ever lose control of cash. So we try and centralize the absolute minimum, and we try and empower the brands as much as possible, except where it doesn't make sense, because it's just commercially doesn't make sense for each brand to build its own function, and then we get duplication. But Noel, happy to take your contribution as well.
Yeah, just to add to it, Ghost, I mean, we'll have some of those typical areas in the back office that are controlled from let's call it a central point. Very much the accounts receivable, accounts payable, the treasury, the HR functions are centralized. And I suppose one of the largest parts of our business is payroll, and that'll be payroll for our permanent staff as well as our non-permanent staff. But that doesn't mean it's a standalone sort of position that we don't have very intimate interaction with our businesses. So in all instances, the businesses are involved, but there is a control element at the group. And that's very much from a South Africa perspective. In Australia, it's a little bit different. It's a little bit more decentralized, but we are currently looking at about putting a bit of a central structure together there to ensure something similar is followed. So it's very much a model that's morphed over the last sort of 5, 6, 7 years, and it's certainly working for us at the present time.
Okay, so no risk of you becoming an investment holding company overnight, eh? It sounds like you're happy with where you are.
Yeah.
On that. Okay, perfect. I see there are some hands coming up. If you guys could please just DM me your questions. It's just easier so we don't have people putting their videos on or whatever. And we have all kinds of exciting things when that happens. We've learned this the hard way. So if you wouldn't mind, just DM me your question. That will be most helpful. So I think let's move on to, I know what I want to ask actually. So in terms of visibility around revenue in these underlying businesses, particularly as you're looking at acquisitions, disposals, managing your business, your central treasury, the whole shebang, just how much of this is ad hoc revenue and how much of this is recurring type revenue in your underlying businesses? You know, what level of visibility do you really have over what the next year might look like. Because that's one of the other challenges in a services business, right? Is to try and move from ad hoc feast and famine through to a nice recurring stream, which is more suited to a corporate environment, I think.
Now, one of the advantages that we have is the range of services that we offer. So if you look at, for example, our blue collar contingent, that tends to be more annuity type business. We enter multi-year contracts with our clients, and there's normally a base load that we can pretty much predict. And then there will be seasonal variability on those clients, especially if they are in retail or in industrial. You get peak in December, you get peak in Easter, all the way through to our permanent business, which is exactly that. The permanent business very much depends on clients coming and saying, well, I need to recruit a CFO, I need to recruit a supervisor. That's really hard to predict. So it goes the full spectrum. And the nice thing about it is we are then able to, in a sense, deal more effectively with kind of the job shop type brands that we have, which would be a Kelly, it would be a DAV and so forth, the permanent placement. It gives us some flexibility to deal with variations at a sector level, because you also get sectors that struggle. So, last year we saw, in the preceding year, mining did exceptionally well. Last year we saw mining cutting back quite significantly, but then we have other sectors that can offset that. So it is a bit of a mixed ghost. And I think that's an advantage of Adcorp, is that we've got a combination of annuity, which is actually, I think, the bulk of our business. The bulk of our business is contingent, and also white collar contingent, that's annuity. And then we've got the higher margin job shop type roles, which is permanent and project-based work. Those margins are sweeter, but you can't really predict them. It does make it quite difficult to accurately predict what revenue trends are going to look like over the short to medium term.
And John, just to add to that, when you talk about the non-recurring stuff, which we would have mentioned in our investor presentation, is where we've had a quite a large drop off in permanent placements. Not just in Adcorp, it's prevalent through the whole industry, both here and in Australia. You have difficulties to then get that positive operating leverage that you need, which we are getting then through that recurring business. And in some of the brands, Ghost, we have clients that have been with us for 10, 15, 20 years. Not that they should give you any comfort, but it certainly demonstrates the loyalty to the brands.
Absolutely. So I've got a question in my DMs here around your target margins, which will be interesting to talk through. I'm also going to throw a hard one your way, which is just a concern around margin trend in general, specifically in professional services, because I think there are two big trends that are tough for you guys. So the first would be obviously the rise of something like LinkedIn. People are finding a lot more stuff directly. I mean, if I think my first role outside of articles I was placed in, these days it feels like the market's maybe a bit different. And the second trend would be the scary one for a lot of people, and it's impossible for you to answer, but maybe you do have a view on it. It's just, the extent to which AI is starting to replace the number of new roles in a business, and automation and everything else, and what that means for total job postings. So the question is really around target margins and trend. And then, I can't make the whole session easy for you guys. So tough question around a couple of those trends.
Sure. So let's just take them in order. We have previously messaged to the market in results presentations that our long-term target operating margin is in the 4-5% range. We're significantly below that right now as a consequence of the situation in South Africa with the economy, and to a lesser degree in Australia. But our long-term trend, our long-term goal is sort of 4-5% operating margin. We are some way off that now. The primary reason that we are off that was very much our professional services business. As you point out, that's been what hurt us last year, particularly in South Africa. And that was a combination of the permanent market, not returning, but also some of our other higher margin offerings, RPO and MSPs. These are where, when companies are not hiring, we're not making the permanent placements, those margins are really sweet. If you then look at companies not hiring, they're also not going to be hiring 200-300 people at a time, and that's generally RPO and MSP. So last year we saw a significant decline in demand for permanent managed services provision and recruitment process outsourcing. And we have also indicated that our professional services business, we are making some significant changes there in terms of cost reduction, some restructuring, some repositioning. In Australia, we're doing the same with our professional services business. There we've got significant exposure to government, about 50%, and we would like to diversify that. So we do acknowledge that margin, particularly in professional services, has declined in the prior year. But if you look at the long-term trend, yeah, we had a tough year last year in professional services, but we've got specific plans to address that. The final part of your question is the impact of AI. It's a question that we get asked a lot by our clients. And where we see AI impacting is not in wholesale replacement of roles, because AI certainly is causing some roles, especially oddly enough in IT. So if you look at coding, you look at testing, you look at UAT, certainly the AI or the LLMs have the ability to do that better than your typical coder. But we are seeing the creation of new roles that didn't exist before. So it's a bit of a mix, but we do see a net reduction in, for example, IT as a consequence of AI. We also see AI impacting other sectors such as BPO. And I don't think that AI is going to result in large-scale displacement of jobs. I think two things are going to happen. We think two things are going to happen. One is that, if you're an employer and you worry that AI is going to replace you, AI won't. The person who knows how to use AI is going to replace you. That's the first thing. And then the second thing that we are seeing in terms of AI, it's very specific sectors where it's having an immediate impact, mostly in the high-tech sectors. And that decline started in October 2022. And it's been a global decline in IT associated with LLMs. But it's still early days. We are watching that the impact of AI very, very carefully. We ourselves are starting to make use of AI. I think it is going to be a transformative effect in the industry, but it's really going to wash through the system only in the next 2 or 3 years, but it's already well underway. I don't have an answer fully, but it's something that we're watching carefully.
I share pretty much all of those sentiments. AI disrupting IT jobs is like when you cut that branch on the tree off, the one you're sitting on. I mean, it's quite amazing. There's going to be a lot of change. It's happening already. I think we got time for literally one more question, which is one that I quite like, and you're going to have to give a quick answer because of time, but if you could really distill the lessons from the past couple of years and maybe, learning from some of the mistakes previously made at Adcorp, even before your time, etc., if you could summarize that into succinctly, like what is different? What are you guys really doing differently now versus where the group has come from that caused a lot of the problems?
I think 3 words: cash is king. We've done it better than at any other stage in the company's history. We live and die by cash, and I think previously the company lost its way. Secondly, you exist because you have customers. If you lose sight of your customers, they're going to go somewhere else. And I think for the last couple of years, without judging our predecessors, I think we got wrapped up in our own busyness, if you like. And we wanted to create this big Adcorp that did everything to all people, and we lost sight of the fact that our customers love our brands. That's the second thing that we did. I would distill it into those 2 things. Cash is king. Focus on your customer.
Yeah, I like that. Noel, anything you want to add to that?
Yeah, no, certainly. I think we could go on for 10 minutes, but
well, we've still got 2, so you're welcome to use both.
Yeah, look, we've inherited a lot of things from the past, and I think we've done a lot of fixing over the last couple of years, and this has allowed us to get into that position that we can start thinking about acquisitions going forward. We've got to maintain it. We're well aware, and we've said it to the market. We've come under margin pressure in the last 12, 18 months. Some of that's controllable, some of it's not controllable, but certainly that stuff that we can control and can change has got a lot of focus from us at the moment. And at the end of the day, we need to keep growing to manage some of the costs that are within our business. It isn't just a tap you can turn on and off. It's a big ship, and we've certainly managed to turn it, and now we just got to get the engines to go a bit faster.
Yeah, absolutely. So I see the breakout room is closing in the next minute, I guess. Last 30 seconds, I'm going to just ask, I'm sure I know the answer to this, but Adcorp will certainly be a beneficiary if the political situation can be more steady and more business friendly in SA. I'm imagining you've seen a bit of a slowdown in the start of this year. I've seen it now in Nedbank's numbers, ABSA's numbers, Sapaku's numbers. So I'm guessing that's been a similar story for you. And yeah, let's just hope, I guess, that things get better and companies have more confidence to actually hire and do all of the things that you need, because at the end of the day, SA economic growth is going to be a big driver for you guys.
Absolutely.
Yeah. Thank you so much for joining the platform, and it really has been great. I've really, really enjoyed it. So the breakout room will close in literally the next 5 seconds. Then we'll all go back to the main room and we can all say goodbye. But thank you very, very much, John, Noel. It's been great to have you.
Thanks, guys.
Thank you, guys.
Thank you to everyone who participated in Unlock the Stock today, and a big special thank you to John, Noel, Kim, and Christian for making the time available. We really appreciate that you could support this Unlock the Stock, and thank you for the lovely conversations that were had. We hope that you've enjoyed this event today, and if you'd like to listen to it again, just as a reminder, it will be on the Unlock the Stock YouTube channel next week. As we have reminded you before, July is extremely busy. We have a function happening every Thursday during July. And the first one up will be PBT Group. That'll be followed by Capital Appreciation and Attack. There'll be a session on REITs in South Africa, as well as Teresa. So we look forward to welcoming you back to those. And if you want to just look out for the invitation or follow go to our website just to get the details there. But other than that, thank you everyone for participating, and goodbye.